All right. Hello, everyone. Welcome. Feel free to drop a comment in the chat as you tune in. Sorry for the little delay here, little technical difficulty, but we are up and running. I see a bunch of people were already dropping in the chat before we got here as well. And we just need to wait just a couple minutes to where we go live on all the different platforms. So we just got to wait a second here. Oh, lots of people checking in there. Hello from Texas. Hello, everyone. Hello, hello. Hello, Cameron Root checking in. All right. Hello, everyone on the team checking in. We're just going to wait just another minute so we can make sure that we're live on all the platforms before we actually get started. Let's see here, going on in the comments. Hello, team. Hope everyone's working those leads. Absolutely. If you believe it, you can achieve it. I love the inspiration, Cameron. Love it. All right. Looks like we're almost ready to go here. Oh, it looks like perfect. Got some new people tuning in as well. All right. Look at that. This guy Cameron Roots dropping knowledge in here. The fortune is in the follow-up. I love it. Let's get motivated, baby. Okay, looks like we're live on all the different platforms, so we can take the chat out now and we can get started. I don't think we'll go too long today. We'll probably keep it pretty short. But today, what we're going to talk about is structuring loan files and talk about the importance of that. So we've done a lot of these trainings where we're doing quotes or we're doing all these different things. But right now, we're going to talk about actually sizing up the deal. And this is something that Jose is very big on and something that you're going to have to go through, whether you work at the mortgage calculator or work somewhere else. The key is going to be to size up your deal and figure out how you're going to structure it. Now, it's especially important to us here at the mortgage calculator because we deal with so many different products and so many different clients and investors that we have all of these deals being thrown at us, and the client doesn't even necessarily know what type of loan they want, right? We have a lot of clients that click on ads for something, and then we end up doing a loan in another type of program, right? Just because they clicked on a certain ad doesn't mean that that's the best program for their actual scenario once we actually open it up and dig deep and find the way that we need to actually structure the loan. So I want Jose to talk a little bit about, we're going to do this kind of in two parts here, Jose. The first part I want to talk about is just the upfront structuring in the very beginning, right? When you're sending out your quote. So you've spoken to this client, you've gotten some information from them, but we don't have their documents yet or anything, right? This is going to be an upfront, what kind of quotes should I send them? What kind of program should I be looking to put them in? And then the second part is going to be after they've already decided to move forward and they've actually filled out an application and given us their documents. At that point is another kind of structuring point that we come to that we need to actually structure. So Jose, let's talk about that first structuring part of I spoke to this person. Now what do I do? What kind of quotes do I send them? How do I know where I'm taking this loan?
Yes, good evening, everybody. Thank you for joining us. Very important because the structure actually begins at the moment that you are sending out the quotes and also setting certain expectations with the borrower, right? You're communicating what you're doing, why you're doing. Remember, we're also outside the box here. So it's important when you are sizing up the deal that you try to cover all the possible angles that could be applicable to that borrower. So the structure starts at the very beginning. That's why when I give the training where we're talking about the part of the training when we talk about the call, you know, the communication, excuse me, with the borrower, where they are, you're obtaining everything that you need as much upfront. It's a combination of building rapport, but also figuring out, if it's a primary, if it's investment, the investor experience, the more obvious stuff like credit score, credit trade lines. Are they self-employed? Are they salaried? Do they have overtime? Do they have bonuses? Are they salary and self-employed? Maybe they have W-2, and some side gig income. Number of things going on there, which then is gonna, the more upfront info we can get at that initial contact. Remember, we don't want to just be in and out. We want to have the call, establish the rapport with the borrower, and then you proceed to the part that you were mentioning of now, what quote types am I going to send? That's going to depend on the call that you had. If your borrower tells you they're self-employed, now you know that it's like a really big piece of pie there that you're going to chop up into a bank statement option. I mean, or maybe back up a little bit. You're going to be there at that fork in the road when you're speaking with the borrower. Are you salaried, hourly, or are you self-employed? Right. So you already know then either or. So that then now when you are putting together your quotes, you're going to send if they're self-employed quotes, right? You're going to, if it's a, let's say, primary purchase, you're going to send them a full doc quote, whether it be, let's say, a conventional full doc quote. You can send them a non-QM full doc quote, and we can send them a bank statement quote, and we can send them a P&L quote for primary. If it's investment, we can do, for example, the same full docs and then include in the end DSCR. So now you send your multiple quote options, further engage the borrower, right? Because we are consultants, so we are always trying to add value and make sure that the borrower is being offered the best option for them, right? So then once they determine now, right, the path that they're going to take, they've discussed it with us. Mind you, we haven't looked at documents yet. If this is going to be full doc, it's just been their representation of everything. But now, fine, they're ready to proceed. They accept the deal, and then we proceed now to structure the loan that the customer has applied on, right? But hopefully we did a good job up front of conveying everything well with all the different loan types, especially for self-employed borrowers. And then now we're putting the file together, but it's still the situation. Now you want to make sure that you have the proper income. You're going to do the income review. You're going to run it through the income calculator. If it's a self-employed borrower, you're going to have your year-to-date pay stubs and tax returns and W-2s, whatever is applicable for the loan for the salary borrower, and just do your income analysis.
All right. So how important is it to give the clients options? I think one of the things that loan officers don't do enough of is give clients the options as far as the quoting goes, right? So we're still, well, let's keep talking about here the upfront part of quoting them with different scenarios. I hear you say a lot. It's when you start sending a multiple scenarios, it becomes less about yes or no and more about which one are they going to go with, right?
Yes, sir. Absolutely. We can't be afraid to confuse them if we're on point with all the options we're giving, but we do have to give options because we don't want to lose them because they think we didn't offer them a 40-year interest-only option. They may think we don't offer it. So ask them, offer it. The more options you offer them, more reason for them to keep engaging us, for more explanation. And eventually, then, like you mentioned, at that point, it's going to be all right. I got a lot of good ones, which is going to be the best one for me. I like that one. And then, start loan application. Magic blue tab right there.
Yeah, so they're choosing between one of our deals as opposed to between our deal and another deal, right?
Correct.
Between our
Correct.
quote and another quote, they're choosing our quotes together, right? They're picking which one, and so it's very important. But also, what's very important, as Jose just mentioned, being afraid to confuse them because you can. But that's why we need to be very precise. And I go over this so much about the name of the quote needs to be very precise and accurate. The comments in the quotes need to be very concise and accurate so that the client can easily tell which quote is what and easily be able to differentiate from them to know, okay, I get it. I have this one that's full doc and it's probably conventional full doc is probably the cheapest, right? I then have these options to go bank statement, which is going to be more expensive, and these options to go P&L, right? So if we do our job correctly, we should be able to give them multiple options without necessarily confusing them. Now, sometimes you may confuse them, which Jose said, hey, that's great. I'll be on the phone with them, to clear it up, right? Even more reason for a phone call. If you have multiple options, then they're going to call you or request a call for clarity as opposed to just ignoring the one quote that you send them. So, great idea to send multiple quotes as long as they fit within the structure of what your clients told you, right? Don't send them random quotes that don't make sense from what you interviewed them. But as Jose said, one statement of self-employed opens up this huge fork in the road where you're going to go this way and have all these different options that you're going to be able to give them. But please just make sure clear, concise quote names, clear, concise comments, whether you're on our team or on at another company. If you're sending people quotes, make sure that they know what they are looking at. Absolutely. So now let's say they've filled out the application, they've uploaded some documents. So now you got documents, right, Jose? You got an application, you got documents. How do you sort through these? They might not qualify for every single option that they may have, right? Now that we're going through documents, now we are going to find things that would either disqualify them or qualify them for different things, right?
Correct. I mean, obviously, it makes a difference if we're doing an agency loan where now we have automated underwriting that is going to give us a list of findings, going to give us a credit and income approval, and then it's going to be subject to final underwriting, review of our income, and stuff like that. Um, the findings is going to tell you everything that you need as far as documents and whatnot. Same as if we go non-QM, we're going to review the guidelines for the pertinent program, and then we're going to take it from there, and hopefully everything lines up with our document requirements, our credit matrices, income matrices, all that good stuff. And then we proceed. But those are all things that have to get taken into consideration because now, like you mentioned, now we have the docs. Now we're doing our income calculations. And at that point, it's just a matter of mechanics. If it's self-employed, you got the income calculator, you follow the lines and you do your deal that way. If it's a salaried borrower, you have year-to-date pay stubs. If they have a lot of overtime and bonuses, we'll probably have to order a verification of employment written from their employer just to be able to accurately document bonuses, overtime, commission for that type of variable income.
So when we're structuring a loan here, I want Nick to touch on this because Nick talks about this a lot. As a company that does a lot of non-QM, we get all these different people, coming to us requesting quotes for all these different programs, which is great, right? We provide solutions. However, sometimes they didn't necessarily need a special solution. So we're always going to take them through the route of what may be best. So can you talk a little bit about that, Nick, and how as a loan officer, we're going to always look at the best options, even if they fast forward and think they need a bank statement, that's never going to be the cheapest option, right? So let's touch on that a little bit, Nick.
Sure. So I have a document in our trainings for the hierarchy of this, but it's very important that we follow this. It's actually legally required, guys. Us as licensees, all of us here watching this that are licensees, right? We have to take them through the best benefit. And I love the new 1003 that just came out last year, right? Because now it asks every borrower if they are a veteran, right, or if they've served in any armed forces. So even if you guys forget to add that to your interview, which as Jose was mentioning, the interview is very important. But if you don't ask if the borrower possibly is a veteran and may qualify for VA benefits, I love that the new 1003 asked that for us. So when Jose saying, we get the 1003, we get the docs. Now we can say, oh man, this borrower qualifies for VA, which VA is typically at the top of the hierarchy, right? That's going to have the best benefit, the most benefits to all of our borrowers, right? And then typically there's also, USDA, if a property is in that right zone, has a lot of benefits. So that would typically, if it is possible, that would be kind of the next. And then typically conventional, FHA, then we can go into non-QM, then we can go into like CDFI, then we can go into there's really no other option there besides like hard money and stuff like that, but that's really for investments. But we got to make sure we're following that proper hierarchy from the best benefit to the customer, right? For us at our team, right, we have it set where no matter what kind of deal the customer is going to do, there's no difference to the loan officer, right? So we always have the customer's benefit in mind because we're not going to have an incentive to go one way or another. We're always going to provide the best deal for the customer, not only because we're required to by law, but because we don't have any other incentives that are misaligned, which is an important piece of the puzzle for borrowers to know that there is no reason that one company is pushing you towards one product, right? So you got to watch out for that when you get like sometimes these, for example, these builders incentives, right? A lot of builders will have a lender in house and they'll push this lender and this loan program really hard because they have some incentives. But in reality, it's not the best benefit to the borrower, right? If a borrower could qualify for VA, but that in house builder's lender, right, just gets them on the fast track for this special program that gets them all these incentives, but it probably wasn't the best rate and benefit at the end of the day for the borrower. That would be where I would have a problem with that as the owner of the company, right? So we want to make sure that all of our team doesn't fall in that trap of trying to push someone towards anything. We always want to go from the top down and make sure we go in order of hierarchy to make sure it's the best benefit. Customers don't always know if they're eligible for VA benefits, so that's why we can always log into our VA account and pop in their information and see if they do have armed forces experience. And if they do qualify for conventional, like Kyle was saying, they click on a bank statement loan ad, doesn't mean that we don't look at their tax returns, right? We're still going to ask for their tax returns. We're still going to analyze their tax returns. And if we do it properly, many self-employed borrowers will qualify with their tax returns. That's why it's very important to do the proper structure. We did that a couple weeks ago in this training, right? The full 1080 worksheet. All the worksheets for self-employed borrowers. If we do those properly, a lot of times we can get that extra juice we need to keep them at the higher end of the benefit to the borrower, right? But we always have those options for non-QM as we go down in the order of the hierarchy. So I don't know if there's an official name for it, but that's how we treat it. And it's definitely something that we are very passionate about. So hopefully that answers it for you, Kyle.
Yeah, absolutely. So, Jose, we got the application. We're going through. We're saying, okay, this seems like the best benefit. I'm going to try to qualify them. Conventional. Let's run DU. See what happens. Maybe it's VA, but typically probably conventional. We're running DU. We're seeing if it works. It doesn't work. What's the next step then? After that, we're running DU. Can't get approved eligible. What's the next step?
Okay, well, if we've analyzed the income properly, right, and there's the issue now, I guess we'd have to see why we are not getting an approved eligible in DU, right? Normally, uh, it's either going to be your DTI is too high, which you know before you run it. If you're above 49.99%, and your LTV is 95% and your credit score is 700 or above and you're not getting an approved eligible, there's something odd
Don't
going
even
on.
click it.
Right.
Don't even click.
But I mean, at that point, let's say assuming You've run it a bunch of times. Your income is correct, right? There's nothing wrong. The issue is here usually going to be one with credit. There's something that automated underwriting doesn't like about that file that is usually going to be either LTV driven. The lower the LTV, the less risk. At which point, the algorithm may say, "Okay, now I like you. I like you at an 88%. I don't like you at a 95." Something like that, right? So, but if lower LTV doesn't solve it, and you still can't get that approved eligible, then you got to start considering non-QM. So you can take your full doc borrower to non-QM, assuming you can meet the minimum the maximum LTV, which is usually on a full doc file going to be 90%. So at that point, it's a lot easier. As I stated in the training I do, why would we go non-QM with a full doc borrower, right? Theoretically, people always think full doc is going to be conventional, but right here, manually underwritten file. And then now you're saying, okay, I meet the credit score requirement. I meet the trade line requirement if there is one. My assets are good. There's no charge offs to worry about here. No late pays on the mortgage that would kick me out of the credit grade. Everything looks good. Boom. I'm right here. And now at that point, see what pricing the borrower picks for the loan, and then you have your file to disclose, assuming you can go full doc and the issue was only automated underwriting. However, if the issue is now, hey, I looked at it and my DTI is 55% on a good day, and everything here is at 50, and DU didn't take it either. So, and I can't go FHA here because for whatever reason, because that could be another option, if it's DTI driven and you could do 56.9%, then you could possibly find that as an option. Maybe it's USDA possible. USDA has some relaxed credit score requirements as well. You never know. You could try to see if that's an option. If we're going to stick, maybe your person's a veteran. That would be, we would be so lucky if that would be the case, because then we'd be running them through there. But if none of those are the case and we got our self-employed borrower, then now we put on our, real thinking caps on, and now we're looking at bank statement option as a very good full doc option. In a lot of non-QM, in the non-QM realm, a lot of times full doc with tax returns is the same exact rate as full doc with bank statements. They view it pretty much the same. So you're not going to get much difference in pricing there at all. But the difference is now that borrower, you were looking at tax returns and you were hoping you could get them, squeeze them in at $6,000 a month for the DTI you needed. Now you're looking at bank statements and you're looking at $18,000 a month as the income that we can document. Now all of a sudden he's like, "Oh, Jose, really? Maybe I should go back to the realtor and get a bigger house, right?" But they should be so lucky to have that many options. But when they work with us, they usually do.
So we got a question here that goes right into that. So I wanted to bring this in before we go further. But Julie was asking here from LinkedIn, how do we deal with a client that's basically having a fallout with a mortgage broker? I assume that's what she means, that throws pasta at a wall and hopes it sticks. And more brokers are baiting and falling out of escrow. I've saved a few 15 to 20 days in. So I'll put a comment on that, and then I'll have Jose continue his kind of deal here. But what I really think it is, guys, it's because of this non-QM, and we've been doing this for a long time. And that's why we really specialize in this and what we really shine at, right? Where a lot of other mortgage brokers, it might be new to them, where they might not have read the guidelines. That's why we're doing this training right here, right? The structure is what it's all about. So obviously that mortgage broker that, threw something at the wall didn't take this training, right? That's the whole difference between what we want everybody that's here today. I think there's 116 people watching right now at this moment. All of us here watching should not be that person, right? So let's not do that. First off, let's not throw stuff in and just see if it works. Let's read exact guidelines word for word. As Jose said, we're going to read the credit guidelines. We're going to read this and that. And I think it's a lot of them are trying non-QM for the first time. That's really why it takes some experienced people like Jose, who's done non-QM for 20 something years, done a lot of foreign nationals, which has been non-QM before non-QM existed, right? Done subprime when non-QM was a whole different word, right, Jose? Uh, but it's important that we know exactly what we're doing and we read the guidelines. But I'll let you go ahead and kind of go through this, Jose. How do you save it if someone comes to you and had a fallout? Because you do this all the time. This is like your specialty, right? Jose's the resuscitator, the lifesaver of loans here.
What you call those heart machines?
Yeah, the paddles, the bibs, right?
Defibrillator, whatever you
Yeah.
call those things. Yeah. Well, I think, and those here that are on a team that are listening tonight will know how we definitely love to pride ourselves on in being consultants, right? And that's why we like to be hands on and know what's going on with the deal so that these things don't happen, right? So that a customer doesn't slip through the cracks in a wrong trajectory loan. Which then this is going to go into the second question there. We're going to answer them, 2 for 1 here. But um, I think we have to empower the borrower, and we love to do this when we're talking about all of the different options that we have, and we explain the why and how everything works. And we like to set expectations. We have the main objective. Yes, this is the one we're going to shoot for. If it's a scenario that may have issues that's been made clear to the customer, then we have our plan B, and then, if necessary, we have our plan C, and everything is out in the open. Expectations have been set properly so that if we do have to go from A to B to C, they understand, they've been empowered. So we're not going to be, and we definitely don't create at the mortgage calculator the MLO to spray and pray, right? When we give pre-approval letters, for example, for an agency loan, there has been AUS completed of real data, of real pay stubs, analyzed tax returns if they're self-employed, whatever it is that we had to look at, and nothing's been fudged. And then, because if it doesn't work out conventional, we have other options, right? There's no reason to put a square peg through a round hole because we don't have other options. Like maybe the reason why a lot of these other outfits may do that, you'd have to ask them. But we certainly don't train our MLOs that way. They'll all let you know. It's all in their training on. We give that letter when it's there. So definitely, it's empowering the borrower, letting them feel like they're part of the process, and that's how you overcome that. Because you'll hear they'll complain about people just bait and switching, becoming non-existent in the deal because they were the application taker. They turned in an application and then somebody else is doing it, and the borrowers get lost in the shuffle. Totally different to our experience here.
So, Jose, before we move on from that, real quick, just a great example of what that would be like. Simple example, right? You have your plan A, and then, like you said, you have multiple plans. But let's just talk about just one. So, let's say we're trying to do whatever loan it may be. You may know some things in the guidelines that may come up, and you may let your borrower know, look, if this is the case, we might have to go another 5% down on the LTV, right? That would be a perfect example, right? Of your borrower already knowing that if we run into these issues, we could still do the deal, but we're going to need to put an extra 5% down. I know that's a situation that you run into a lot, right? As a perfect example.
That is a perfect example. Perfect example, especially with the DSCRs, when we're structuring those short-term rental deals. We're, moving around, and sometimes when we move around, we get an LTV hit if we're doing STR. So for sure.
So I also want to make sure you guys quote those too, right? We want to make sure not only are we clear that things might happen, but there's a quote that's actually been received, thought about, put in their head for A, B, and C, right? A, B, and C are not in your head, right? As the MLO, right? A, B, and C are implanted in the client's head, not only in their client's head, they're actual physical items, right? They're a physical quote in their email that manifests in their head, right? It has to be real, right? We have to make A, B, and C real so that when A doesn't happen, A's great, right? A's the best of all worlds, but then we all know what happens when B happens. We don't quote then, right? I think that's what Julia's question goes out to as well. You put a number in Oz to try to make it work. You get a pay stub back or a VOE back that doesn't quite line up with what you put into Oz, and you're stuck, right? But like Jose said at the mortgage calculator, we don't need to fudge those things because we're going to use what we have first off, which is the way we should do it. And then if what we have doesn't meet the guidelines right now, we're going to go bank statement or P&L or any of these other options we have so that we can do the loan. And then we can tell the borrower, hey, we're going to go with B today. If you get me a VOE that says X, Y, and Z, we can go back to plan A, right? So A, B, and C doesn't always mean that if A doesn't work today, that you go to plan B and plan B is the only one. Plan A can come back into play too. So remember, guys, plan A, B, and C, these are all moving targets, right? We're on a loan. Every document that comes in moves the target a little bit. So A, B, and C are real tangible items that we're going to hit. We're going to hit one of them, right? We're always going to make sure we have one that's going to get hit, but always keep that in mind. For example, Jose, how often do we rescore a borrower the week of closing so that we hit A instead of B and C, right? A, B, and C could just be 700 credit versus 720 credit. That could be a big difference, right? My personal loan, Jose saved me $10,000. I got a $10,000 difference between initial CD, final CD because of a rescore, right? Can make a big difference on pricing just from a small change in score, small plateau. So small targets, ABC, big targets, conventional versus bank statement, that's a big difference. But also, I wanted to touch on this morning, guys. Remember, if you guys watched our show this morning, bank statements APR was around 7.5. Remember, conventional this morning was around 7.1, I believe, on the APR. Bank statement and conventional are almost identical today. So for our team out there, again, there's no benefit to putting a square peg in a round hole, no benefit to fudging Oz, as Julia had said. So I just want to get those points across as well. Sorry to
Absolutely.
interrupt your flow there, Kyle.
No, absolutely. And I think just a good point to make too is just that we're never going to have a client say that we can't do the deal, right? And that's the whole ABC. If you need D, E, F, G, the fact is it's never going to go, oh, they can't do that, so I'm looking for somebody else, or I'm going somewhere else, or something dies. It never dies. It just moves, right? Our goal just moves from A to B to C. There's never a time where we say, hey, we can't do this, we can't do that. We're just saying, hey, we're going to need to move to this option. So when you have things lined up like that, you have the proper quote sent, you have the proper expectation set. There is never a time where the borrower just goes, okay, dang it, I'll have to go look somewhere else. Or, okay, I got to go talk to somebody else. They shouldn't even need to inquire because you've mapped out exactly what we can and can't do and are walking them through these situations. I think it's a great point to make.
Want me to pop up the second question that goes
Yeah.
right into this? Okay.
Yeah, let's go ahead and take the questions, and then we'll get out of here after that. I think it's great to take a few questions. And
So we've been talking about this, Jose, but I think you wanted to address this specifically.
Well, yeah, that's why we were talking about setting the expectations and having your plan B and plan C, and you mentioned conveying it clearly, as in sending the quotes out and establishing those points, right? If that happens, you're not going to get fussy. They understand. They get fussy when all of a sudden things change, and they weren't told any of what they could have expected. They were led to believe everything was hunky dory. We're 100% in on that deal, that beautiful deal that was proposed to them, and all of a sudden, we get the real deal, and it's not what they thought it was. But and we know it could have happened for a valid reason, but the issue was that that should have been reviewed and that should have been discussed with the borrower beforehand. A lot of these things we know are there, and we just got to let the customer know, hey, listen, it may not work out, and that's it. Some people forget to do that part.
Perfect. Let's see the other question. Okay, this is a good question. This is a good structured question right here, Jose. Why don't you take that?
Yeah, maybe that was the show. Remember the ultimate house hack
Yeah, that was
four
yesterday's
unit?
show.
Yeah, four
I guess let
unit.
me ask you the question for the people that are just listening and not
Yeah,
watching. Is it possible that a client doesn't qualify for a property worth 200,000, but qualifies for a loan for a 4-unit building, considering the rent?
absolutely. When you are purchasing now here, this could be two different purchases. This could be a primary purchase, right? This borrower is buying a 4 unit primary, or it could be a non-primary. It could be investment. In either scenario,
Her follow up was the 4-unit 600. So there's your parameters there, Jose.
okay, again, so all right, so they don't qualify for a $200,000. I'm
Solo.
assuming
Sing.
maximum loan. I'm
Yeah.
assuming maximum loan amount, right? But could they qualify for maximum loan amount 600? So in both scenarios, let's consider FHA, right? So you could do that $600,000 purchase with 3.5% down, and you could qualify for using 75% of the unseasoned rental.
Got some background noise going
Yeah, you
on
got
over there.
construction
Yeah,
going on.
sorry about that. Yeah, quick note there. So you could get 75% of the unseasoned rental income. So if it's an investment property that you're buying, each of the units, you haven't cleaned them on the tax return yet, that's an unseasoned rental. So you get 75% of that income. And if it's a purchase, well, you get 75% of the other 3 units, other than the one that you're occupying. And that could theoretically, if the rents are good, let's say it's, 32323232, and they're $1,500-$1,600 a month per 3 bedroom, 2 bath, and you get 75% of that income. That's a lot of extra income that I think could potentially make up the difference there for that borrower.
We've definitely closed some people that wouldn't qualify on their own for anything near, right? Done some over $1 million 4-unit FHAs, which is pretty crazy, right, Jose? Those are
Mm.
it's just weird. It's just crazy to get $1 million plus FHA loan, right? But we can get up in there in California and the high ticket areas
Yep.
in the multi unit. So that's pretty crazy stuff.
All right, I think that's
Any other
the questions.
questions?
But yes, we did do the topic of that on our Does It DSCR last night. For anybody that didn't tune in, you can go to our YouTube channel and check it out. The Does It DSCR, where we went through a lot of that.
There's another couple questions not exactly related to this. Anybody else have a structure related question? I guess the other thing that I want to just talk about, Jose, is if we do have to change from A to B, what do we need to be aware of? Obviously, a COC is the least of our worries, right? But what exactly do we need to know when stuff does hit the fan, right? And something has to change, and we possibly are under the gun, right? What exactly are we need to be aware of when we go
Okay.
from A to B?
Well, I'm assuming here that we're talking about a scenario where we already have a disclosed loan. It's been reviewed by underwriting, and it's been kicked back for not qualifying for that specific
Yeah, I'm
program.
guessing we did our best, right? We talked about structuring, right? We did our best, and then now we disclosed it, but something comes up, right? We can't
At
control the
this,
world, right?
I mean, if we're pressed for time, first of all, we have to see what channel of submission we're going to maintain, right? Because we're going to be switching around options, programs. We got to see, are we going to be staying on a correspondent route? Are we going to go wholesale? Are we going to have to change title? Are we going to have to change, do transfer letters on appraisals, stuff like that? So there are certain mechanics, things that are going to come into play if we are pressed for time. Definitely that. And then just always reviewing the guidelines and making sure that we're sticking to what we need. I mean, it's pretty much usually in black and white. It's only certain scenarios that should ever come up with these things. It could be an undisclosed debt that just popped up, undisclosed property that we didn't know existed, so just we have to be aware and have other options.
And I mean, I just wanted to just touch on that it's not the end of the world, right? We want to make sure that we don't panic, we set expectations. Also, there's legal things that go into play, right? If we're under escrow and there's some sort of deadline, we need to make sure we notify all parties so they can pull money if need be. They can get extensions if need be, right? A lot of those types of things. Um,
Very, yeah. Oh, very important. Yes. When you mentioned extension, it's not just extension to the closing date, but the very important one to us, the one that very few people get, is extension to the loan approval period or the financing contingency period. If you have 30 days per contract, that's why you have to really look at the contract here. I guess is what I should have answered when you ask what consideration do you take as well. Let's look at the contract and see when our financing contingency period expires and make sure then that the buyer's agent requests an extension to that financing contingency period so we can still keep tweaking the financing. Because if they get an extension of the closing date but not an extension of the financing contingency period, and the financing contingency period expires and all of a sudden the deal wasn't able to be saved, and now a denial letter is issued beyond the financing contingency period, now we have a potential situation where the borrower's deposit could be at jeopardy.
we don't want to be the responsible party of someone's deposit being in jeopardy, right, guy?
No, that's the worst thing for sure. Let's see here. I think there may be some other questions. I don't know if there's anything to actually answer here. Oh, yeah, I think we're okay. All right. Well, I think the main takeaway here from today is just make sure that we're structuring the files properly from the beginning and make sure we're managing expectations, right? I think the biggest thing here for everybody to consider is have backup plans, not only plans, but quotes, right? It makes a huge difference to see them when they have those in their inbox and they can go re-look at them and say, oh yeah, you did, you sent me those 4, we looked at them, we talked about them, we said we may have to go to A, B, C, or D. Oh yeah, this is route B, I have that quote, let me pull it up, let's look at it, look at the structure, right? There is something to it. It's not just like you're telling them, hey, remember we talked about it 2 months ago when we started this loan, do you remember I told you about this other program? No, this is a real, like Nick said, it's an actual thing in their inbox, something that they can actually reference. It's real. It's become real. It's not just something we talked about in passing that may have to happen. It's, hey, here's the different routes that we may need to go for these reasons. Let's be prepared. And I'm going to lay them all out to you and show you so that you have them. Let's start working towards plan A, and hopefully that's where we can take it all the way through. But we know what plan B, C, D, E, and F is. I mean, here at the mortgage calculator, you got plan all the way through Z, right? You got everything under the sun that you could possibly do. And like I said, including sometimes you might have to put a higher down payment down, which leaves you to where, of course, you can do anything, right? If you're putting down a little bit more money, tons of programs are popping up, tons of different stuff. So, just keep that in mind. Jose, were you going to say something?
No, just couldn't agree with you. I was almost breaking my neck agreeing with you so hard.
Okay. All right. Anything else, Nick, Jose, that you guys want to go over before we get out of here? We're ending a little bit early today, getting 10 minutes early out of here. We're good?
Just stick with it, guys. As long as you structure it properly, and then when changes come, just restructure it. Right, you're going to go through the same hierarchy again. Something changes, and income doesn't go your way. Something else might go your way. Right, you just always got to be hitting those targets and making sure you're reading through the guidelines. You can't hit those targets and offer A, B, and C and D if you don't read the guidelines. Right, so it all comes down to guidelines. We read guidelines every day. We gotta love them. So stick with them.
Absolutely. Okay, well, thank you, everyone. We do this every Tuesday night, 7 p.m. Eastern. And then tomorrow night at 7 p.m. Eastern, we have the sales training, our loan officer sales training, which I love. It's great training. So tune in tomorrow, 7 p.m. Eastern time. And of course, our daily mortgage rates live, which we do 11 a.m. Eastern time every weekday. So we will see you tomorrow at 11 a.m. Eastern time. Thank you, everyone, for tuning in.
Thanks,
Take
everybody.
care.
Thank you, everybody.